My name is Goetzmann. I'm a professor at the Yale School of Management. I study hedge funds and the role that hedge funds play in the capital markets. There's a theory behind the role of hedge funds that I want to talk about today. And it's based on a fundamental principle in finance, which is the relationship between risk and return. The basic theory of asset pricing posits a relationship between risk, which is represented in this diagram on the x-axis, and expected rate of return, which is represented by the y-axis. The expected return is the return that investors demand if they're going to take a riskier bet. Risk is defined as the exposure to broad market risk, like exposure to the stock market. Sometimes we call this beta risk because of that. Almost anything that you want to describe as an investment lies somewhere in this space. Some of them are very risky, some of them are very safe, some of them have high returns, some of them have low returns. For example, the S&P 500 is a broad stock market index. It typically has a beta of 1, and historically it's had an expected rate of return of about 10%. Now, a very low risk asset is a treasury bill, which has no beta risk, but it still historically has had a positive rate of return, let's say about 3%. We can connect these 2 points in this diagram, and what we get is a security market line, so called because all securities, in theory, will plot exactly along this line. The higher the beta, the higher the expected rate of return. There's a linear relationship between market risk and expected rate of return. Now, the world's not a perfect place, and things happen that will push securities off this line. For example, if Apple comes out with an exciting new product, it can suddenly have a higher expected rate of return, and therefore it could plot above the security market line, which tells you that it's got a higher expected return than is commensurate with the market risk that it represents. By the same token, if something happened to an operating system of another company like Microsoft and the world thought that suddenly the fortunes of Microsoft had changed, it could put downward pressure on the expected return of that company. When these deviations from the security market line occur, everything that's above the line is a good deal. That means you would like to buy it. And everything below the line is overpriced. That means you would like to sell it. Hedge funds exist to exploit these mispricings. They buy the securities that are underpriced and sell the securities that are overpriced. And when they do that, and if enough of them do it, the security prices adjust. Now, the reason this security up here has a high expected rate of return is because it's got a low price. It's a good deal. It's got a low price compared to the returns that you expect to get from it. But when hedge funds and other investors start to buy that, it starts to push the price higher and it pushes the expected returns lower. So eventually it's no longer such a good deal. If everybody has been buying it, the price adjusts and it pushes the security's expected return back towards the security market line. By the same token, hedge funds will short sell securities that are overpriced and drive the price of the securities down and the expected rate of return of the securities up. So what you have in a world with hedge funds is a constant process of investors finding opportunities based on mispriced securities, and then through their purchases and sales, driving the prices back towards the efficient level implied by the risk that those securities embody. When you have prices in a market that reflect the risk correctly, that reflect the expected returns correctly, that leads to a reliable market, a market where investors can understand what they're buying and can have a reasonable expectation about the long-term performance of those securities. If you don't have speculation in capital markets, if you don't have hedge funds, if you don't have some force that drives security prices towards the proper relationship between risk and return, the prices of the securities could be all over the place. And the capital markets can't be relied on to deliver capital to enterprises and deliver savings to investors. So the hedge funds play a vital role in enforcing this basic relationship between risk and return, and we all benefit from it.